Every profitable trader started as a beginner. The difference is, they followed a roadmap instead of trading blindly. What exact steps take you from knowing nothing about trading to building a skill that could someday earn you life-changing money? And what are the mistakes beginners make that stop them from ever getting there? In this video, I'll break down the $0 to $1 million trading roadmap, the same beginner-friendly blueprint that shows you what to learn, how to practice, and how to grow without blowing up your account. Ever felt confused by charts, strategies, or all the trading advice online? You're not alone. Every successful trader once felt the same way before following a clear plan. By the end, you'll know the exact trading path to follow as a beginner, from your first step to building skills that can take you toward long-term, scalable profits. Every legendary trading story starts in the same place, with someone who knew absolutely nothing. No experience, no background in finance, no fancy degrees. Just curiosity, a spark of ambition, and the belief that life could be bigger than a paycheck. If you're starting from zero today, you're in the same position every successful trader once stood in. And that's exactly why this journey belongs to you. Imagine this moment as your first step into a massive financial universe. The charts, the prices, the green candles, the red candles. They all seem like a foreign language, and maybe they are, for now. But so is every skill before you learn it. No one is born knowing how to trade. The greatest traders in the world didn't magically understand markets. They learned them, one mistake, one lesson, one breakthrough at a time. Trading is not just about screens and numbers. It's about transformation. It's about taking control of your financial life in a world that constantly tells you to settle for less. Most people are trained from childhood to think small. Get a job, save what you can, retire someday. But the trading world flips that mindset upside down. It tells you that wealth is not something you wait for. It's something you build. Take the story of Adrian, a delivery driver working long hours in Los Angeles. He barely understood what the stock market was, but he had a dream: to create financial freedom before he turned 40. He started by watching basic trading videos, reading articles during breaks, and studying charts on his phone while eating lunch. He wasn't rich, he wasn't gifted, but he was consistent. 1 year later, he wasn't a millionaire, but he wasn't a beginner anymore. He had a foundation, a strategy, and a quiet confidence that the path ahead was real, because that's the truth no one says out loud. Becoming a millionaire trader doesn't happen overnight, but it does happen through a roadmap, a sequence of steps that, when followed with discipline, take you from zero experience to genuine mastery. Every $1 million trader started by learning how markets work, how to control risk, how to keep emotions steady, and how to turn small, consistent wins into long-term wealth. Before we go deeper, you must understand the most important principle of this entire journey. Trading is a skill, not a gamble. People who treat trading like a casino lose money. People who treat trading like a craft change their lives. Skills grow when you practice. Crafts improve when you respect them. Trading rewards those who study it the way a pilot studies flight or a surgeon studies precision, with seriousness, patience, and focus. But let's be honest, the beginning can feel overwhelming. You're surrounded by new words: leverage, liquidity, volatility, entries, exits, risk-reward ratios. It feels like trying to drink from a fire hose. You might even wonder if you're cut out for this. Let me assure you, you are. The market doesn't care where you come from, what you look like, or how much money you start with. It only cares how prepared you are. This roadmap is how you prepare. In this journey from 0 to 1,000,000, you will go through phases: the learning phase, the practicing phase, the consistency phase, the scaling phase, and the mastery phase. Each phase brings new challenges and new rewards. There will be days when you doubt yourself and days when you feel invincible. Both are part of the process. What matters is that you stay on the path. Think of this like learning to drive. At first, everything feels intimidating. Mirrors, signals, pedals, traffic. But the more you practice, the more natural it becomes. One day you stop thinking about the mechanics and simply drive. Trading works exactly the same way. It will feel complex at the start, but with time, charts will feel familiar, patterns will stand out, and the market will begin to feel like a place you understand rather than fear. You're not here to become a trader for fun. You're here to build wealth, to build something that lasts, to create a financial future your past could never imagine. That is why this roadmap exists, not to make you a reckless gambler, but to make you a disciplined operator. Someone who knows how to build capital, protect capital, and grow capital. In this audiobook, you're going to learn the exact steps that move beginners into professionals. From understanding market basics to building strategies, mastering psychology, managing risk, scaling profits, and ultimately crafting a $1 million trading blueprint that fits your life and your personality. Your story begins now, not tomorrow, not someday today, right here in this moment. As you turn the page to the next chapter, remember this: every millionaire trader was once a beginner. The difference between them and everyone else is that they didn't quit, and neither will you. In the next chapter, we'll dive into the true foundation of this roadmap, understanding what the market really is and how it actually works. Because before you make $1 million, you must understand the game you're playing. Before you embark on a $1 million trading journey, you need to understand the arena you're stepping into. The financial market isn't a lottery machine, and it isn't a place where people get rich by accident. It's a system, a complex global, psychological, mathematical, and emotional system, powered by millions of decisions made every second. When beginners first open a chart, they see chaos, prices jumping up and down, mysterious indicators, confusing candles, unpredictable trends. But professionals see something completely different. They see structure, they see patterns, they see behavior. What looks random to the untrained eye is actually a reflection of human emotion and economic reality interacting in real time. To truly understand the market, you must first understand this simple truth. The market is a mirror. It mirrors fear, greed, hope, doubt, confidence, confusion, and sometimes pure madness. Every candle tells a story of buyers and sellers competing to determine a fair price. When fear dominates, prices fall. When greed takes over, prices rise. The market doesn't think. The people in it do, and their emotions create the movement you see. Let's break down what the market actually consists of. At its core, a financial market is simply a place where buyers and sellers exchange assets. Those assets could be stocks, currencies, cryptocurrencies, commodities, bonds, or indexes. Each asset class behaves differently, but they're governed by the same principles: supply and demand, sentiment and reaction, expectation and reality. Think about the stock market. When a company performs well, more investors want to buy its stock. Demand goes up, And so does the price. When a company suffers, investors lose confidence and sell supply increases and price falls. It's basic economics, but what makes it fascinating is that price doesn't always follow logic. Sometimes companies with no profits explode in value. Sometimes great businesses fall for no clear reason. Why? Because logic doesn't move markets. Emotion wrapped inside expectation does. In the US markets, the largest and most influential in the world, this dynamic is amplified 1,000-fold. One piece of news from the Federal Reserve can shake the entire global financial system. A single earnings report from Apple or Tesla can influence the behavior of millions of traders in seconds. When you trade, you're not just trading a stock, you're trading a global reaction. Now here's where the journey gets interesting. The market isn't one single entity. It's divided into multiple sessions, each with different personalities. The Asian market moves differently from the European market. The US market has its own rhythm. Fast, loud, emotional, aggressive. Many traders only trade US hours because that's where the liquidity, volatility, and opportunity live. Understanding when the market wakes up, when it's slow, when it's dangerous, and when it's explosive is a crucial part of your roadmap. Then there's the concept of market participants. You're not alone in this game. You're trading alongside hedge funds, investment banks, high-frequency trading algorithms, institutional investors, retail traders, and long-term investors. Each of them has different goals and different timelines. Institutions move slowly and strategically. Algorithms react in microseconds. Retail traders react emotionally. When you learn to recognize how each participant impacts price, you gain a powerful edge. Let's look at a real example. During the 2020 pandemic crash, the market fell faster than anyone expected. Fear took over globally, but within a few months, something unexpected happened. The market began to recover. Why? Because institutions saw discounted prices, central banks provided liquidity, and millions of retail traders began buying through apps like Robinhood. Prices didn't rise because everything was fixed. They rose because expectations shifted. The market is always a reflection of expectation, not current reality. That's why you can't treat it like a slot machine. The market rewards those who understand its logic, but punishes those who trade based on hope. Hope is not a strategy, understanding is. Now, to become a millionaire trader, you must learn to see the market in layers. The first layer is price, what everyone sees. The second layer is trend, what trained eyes see. The third layer is psychology, what only great traders understand. And the fourth layer is positioning, what institutions silently do before major moves. Your roadmap will take you from layer 1 to layer 4, step by step. But before you get there, you need the foundational belief that the market is not your enemy. Most beginners think the market is out to get them. They think it's rigged. They think institutions are watching their tiny trades. None of that is true. The market is neutral. It doesn't love you and it doesn't hate you. It simply reflects what's happening between buyers and sellers. If you approach it with respect, discipline, and patience, it becomes a powerful wealth-building partner. Think of the market as a vast ocean. The waves will always move. Your job is to learn how to ride them, not fight them. Traders who fight the market drown. Traders who ride it thrive. In the next chapter, we move from understanding the market to understanding your role in it. Because before you can build wealth, you must first build the trader within you. The mindset, the discipline, and the identity that will define your success in this $0 to $1 million journey. Before you can ever make $1 million from trading, you must become the kind of person capable of doing it. Not someone who chases hype or gets swayed by emotions, but someone who thinks, reacts, and decides with clarity, someone disciplined, someone patient, someone who respects the market. This chapter is about building that version of yourself, the trader within. Because without the right mindset, even the best strategy will fall apart. Every successful trader has one thing in common. They think differently. They don't see losses as failures. They see them as necessary tuition. They don't get attached to wins. They treat them as outcomes of good decisions. They don't chase shortcuts. They build systems. Your transformation begins when you stop viewing trading as a quick money machine and start seeing it as a lifelong skill, one that rewards emotional maturity as much as technical knowledge. Let's begin with one of the biggest truths you must accept. Trading will expose who you are. If you're impatient, it will show. If you're fearful, your trades will reveal it. If you're greedy, the market will punish you. Trading is like looking into a mirror that reflects your psychology through your results. But this isn't a weakness. It's your greatest opportunity. Because once you become aware of what drives your behavior, you gain the power to change it. Consider the story of Ethan, a beginner who entered the market with high hopes and no plan. He would jump into trades because he feared missing out. He refused to take losses because he hoped the price would come back. He overtraded because he wanted to make a lot quickly. His results were predictable: inconsistency, stress, and eventual burnout. But the moment he realized his psychology, not his strategy, was the real obstacle, everything shifted. He spent weeks studying trading psychology, building routines, journaling trades, and practicing emotional control. And slowly he became consistent. His trades didn't become easier, he became stronger. To become a millionaire trader, you need to master 3 pillars of mindset: patience, discipline, and neutrality. Patience means waiting for your setup instead of forcing trades. Discipline means following your plan, even when your emotions scream otherwise. And neutrality means treating each trade as just one of thousands, not a personal victory or defeat. You stop caring about being right. You start caring about doing the right thing. Let's dig deeper into the first pillar, patience. Most beginners blow up their accounts not because they lack knowledge, but because they lack patience. The market rewards the few willing to wait for high probability setups. Some traders take only 3 or 4 trades a week, yet they grow consistently because each trade comes from clear logic. Patience is what helps you avoid overtrading. It helps you stay calm through volatility. It helps you recognize that not trading is still a trading decision. The second pillar is discipline. Discipline is doing what your plan says, not what your emotions want. It means sticking to your stop loss, even when you hope the price will reverse. It means walking away after hitting your daily limit, even if you're tempted to win it back. Discipline is the backbone of every profitable trader. It's not glamorous, it's not exciting, but it's the foundation on which million-dollar accounts are built. And the third pillar, neutrality, is the hardest to master. Neutrality means not taking wins personally and not taking losses emotionally. Beginners celebrate wins as if they're proof of intelligence, and panic at losses as if they're proof of failure. But professionals detach themselves. They know that one win doesn't make you a genius, and one loss doesn't make you a failure. A neutral trader focuses on executing the plan, not on the outcome of a single trade. That's how they stay stable, calm, and confident, even during uncertainty. To cultivate this mindset, you must build habits. One of the most powerful habits is maintaining a trading journal. Every day, write down why you entered a trade, where you exited, what you felt, and what you learned. Over time, patterns emerge. You'll see where impatience shows up. You'll see where fear takes over. You'll see where greed clouds your logic. The journal becomes your personal coach, the one tool that never lies to you. Another habit is creating a pre-trade ritual. Before you enter a trade, ask yourself, is this part of my strategy? Am I acting on logic or emotion? Is my risk defined? Am I prepared for both outcomes? This simple moment of self-checking can save you from hundreds of emotional mistakes. Then there's the power of stepping away. If you're emotional, confused, or frustrated, walk away from the screen. The market will be there tomorrow, but you must protect your clarity and mental energy. Great traders don't fight the market. They wait for it to offer opportunity again. And perhaps the most profound mindset shift is this: you are not chasing money. You are building skills. Money comes as a result. When you fall in love with the process, studying, testing, improving, consistency becomes inevitable. Wealth becomes a byproduct, not the goal. Now here's something most beginners never hear. You become a millionaire long before you have $1 million. You become a millionaire the moment your mindset matches that level. When you think independently, manage risk like a professional, control emotions, and execute with precision, the money simply arrives later as confirmation. In the next chapter, we move from mindset to mastery of road mapping, understanding the step-by-step structure from your first trade to your first 6 figures and beyond. Because now that you're becoming the trader, it's time to build the path that will carry you to that $1 million milestone. Now that you understand the market and have begun shaping the mindset of a true trader, it's time to lay out the actual roadmap, the clear, structured, step-by-step path that takes you from zero experience to your first million. This roadmap is not a fantasy. It's the same structure followed by traders who started with nothing, built skill by skill, phase by phase, until trading became not just a source of income, but a source of freedom. Think of this roadmap as a staircase. Each step prepares you for the next, and skipping even one can cause you to slip. The traders who succeed are the ones who honor the staircase. They climb with intention, confidence, and patience. And as long as you follow this roadmap, your progress becomes inevitable. The journey begins with phase 1, learning the basics. This is where you invest time, not money. You study how markets move, how candlesticks form, how trends develop, and how supply and demand create price action. You explore different markets, stocks, forex, crypto, and begin understanding where your strengths and interests lie. Most beginners rush through this phase, eager to jump into real trades, but this is your foundation. The stronger it is, the higher you'll climb. Once you have the basics, you enter phase 2, building fundamental skills. This is where you learn technical analysis, chart patterns, support and resistance, indicators like RSI and MACD, moving averages, and price action techniques. You start reading charts the way a musician reads sheet music, not as random symbols, but as meaningful patterns. You also learn fundamental analysis, how companies work, how economic news affects prices, how markets react to earnings, inflation, and global events. This phase transforms confusion into clarity. Then comes phase 3, practicing without risk. This is where most traders either grow or give up. You open a demo account, you test strategies, you take fake trades under real market conditions, you journal every entry, every exit, every emotion. You begin to see your strengths and weaknesses. Some of your ideas will fail, others will surprise you. But this phase is where your first real breakthroughs happen, because you learn what works for you before risking a single dollar. After practicing comes phase 4, building your first strategy. This is your personal blueprint, the system that tells you when to enter, when to exit, where to place your stop loss, and how much to risk. You choose your style: scalping, day trading, swing trading, position trading. You select your indicators, your patterns, your time frames. Your strategy becomes your compass, guiding you through chaos with consistency. Once your strategy is tested and refined, you step into phase 5, starting small with real money. This is where emotions become real. Even a $10 loss suddenly feels heavy. You learn how different trading feels when real money's on the line. Your heartbeat quickens, your hands shake, but you stay disciplined because your strategy already tells you what to do. In this phase, your goal is not to make money. It's to follow your plan flawlessly, and then comes a crucial step. Phase 6, mastering risk management. Many traders skip this and pay for it with their accounts, but not you. Here you learn to risk 1% or less per trade. You learn to accept losses as part of the game. You learn not to chase. You begin to appreciate the power of capital preservation, because keeping your money safe is the only way to grow it. Once you've mastered discipline and risk, you enter phase 7, consistency. This is the turning point. Here, your wins don't feel lucky and your losses don't feel devastating. You begin to see patterns. Your strategy becomes second nature. You control your emotions rather than letting them control you. You trade less, but you win more. Your equity curve begins rising slowly, maybe inconsistently at first, but steadily over time. Consistency prepares you for phase 8, scaling up. This is where your account begins to grow faster. You increase your position size slowly and systematically. You go from risking $5 per trade to $20, then $50, then $100. Not because you're gambling more, but because your skills now justify larger trades. This phase is where traders go from hundreds to thousands, from thousands to tens of thousands. Scaling is not about aggression, it's about controlled growth. Finally, you arrive at phase 9, mastery and million-dollar growth. At this level, trading becomes part of your identity. You've seen bull markets, bear markets, consolidations, and volatility spikes. You understand how institutions move and how retail traders react. You adapt quickly. You refine your system. You diversify into multiple markets. You build additional income streams within trading. Maybe automation, maybe long-term investing, maybe teaching. In this phase, your skill amplifies your capital. But here's something incredibly important. This million-dollar roadmap doesn't require you to be perfect. You only need to be consistent, patient, and disciplined. The traders who build serious wealth don't make giant leaps. They make small, correct decisions thousands of times. They compound skills long before they compound money. Take the example of Maya, a nurse from New York who started trading with $500. She spent months learning. She practiced endlessly on demo accounts. Her first real trades were tiny, $5 risked at a time. Over 3 years, she slowly increased her position sizes as her consistency improved. She didn't chase riches, she built skills. Today, she manages a 6-figure trading account and consistently earns more from trading than from her full-time job. Her story isn't luck, it's roadmap. And that's why this chapter exists. To show you that the path is real, the phases are clear, and the destination is achievable. This roadmap is your compass. Follow it and you'll turn confusion into confidence, hesitation into skill, and potential into profit. In the next chapter, we'll dive into the most valuable resource you'll ever have as a trader: managing risk like a professional. Because the journey to $1 million isn't about how much you make, it's about how much you keep. If there is one chapter in this entire roadmap that decides whether you become a profitable trader or another name in the pile of blown accounts, it is this one: risk management is not an optional skill. It is the core of your survival. It is the difference between a trader who grows for years and one who disappears after a few months. And if you're aiming for $1 million future, you must master this like a craft, not a concept. Let's start with a basic truth. You are not here to win every trade. You are here to protect your capital long enough for your skills to compound. Most beginners don't understand this. They obsess over strategies, indicators, and market predictions, but ignore the simple fact that without capital, there is no opportunity. Every dollar in your account is a soldier. Your job is not to throw those soldiers recklessly into battle. It is to deploy them strategically, based on probability and discipline, so they can bring back more soldiers. Professional traders think differently from beginners. When a beginner sees a setup, they think, how much can I make? When a professional sees a setup, they think, how much can I lose? That difference in thinking is what separates wealth from disaster. Let's break this down. The number one rule in risk management is to never risk more than 1% of your trading capital on a single trade. If your account is $1,000, your maximum allowed loss per trade is $10. This does not mean you take tiny positions. It means your stop loss is placed strategically so that if the trade fails, your total loss is only 1%. Most beginners ignore this rule, and they pay for it. They risk 10%, sometimes 30% on a single trade, because the lure of fast profits tempts them, but this impatience always comes back to destroy them. The 1% rule protects you from the worst-case scenario, a losing streak. Even the best traders experience streaks, 5 losses in a row, sometimes 10, but with proper risk management, a losing streak becomes uncomfortable, not catastrophic. If you risk 1% per trade and lose 10 trades in a row, your account is still 90% intact. You can come back with ease. But if you risk 10% per trade, 10 losses wipe out 65% of your capital. And climbing back from that is almost impossible. Now let's talk about the second pillar of risk management: stop loss placement. A stop loss is not a suggestion, it is your shield. It protects you from emotional decisions, surprise market moves, and the temptation to just hold a little longer. A stop loss should be based on logic, structure, volatility, and price action. You place it where your strategy says the trade is invalid, not where your emotions feel safe. Consider a real moment from US markets. During the volatile period of March 2020, traders without stop losses were wiped out in a single day. But traders who used strict stop loss rules survived. even thrived, because they lived to trade when the recovery began. The stop loss didn't save their pride, it saved their capital, and that was far more important. The third pillar is risk to reward ratio. Great traders never enter a trade unless the potential reward is at least twice or ideally 3 times the risk. This means risking $100 to make $300. Why? Because even if your strategy wins only 40% of the time, you still grow your account. The math becomes your ally. You stop relying on luck and start relying on probability. This is the secret behind consistent profitability. It's not about winning often, it's about winning smart. Another essential concept is position sizing. Calculating how big or small your position should be based on your risk tolerance. Most beginners buy random quantities, 50 shares here, 100 shares there. Professionals calculate backwards. They decide risk first, then size the trade. This removes guessing and makes your trading systematic instead of emotional. But perhaps the most overlooked part of risk management is psychological risk. Losing money hurts, not just financially, but emotionally. And if your loss is too big, your emotions override your logic. You start revenge trading. You break your rules. You chase trades. You spiral. This is why professionals risk small. Not because they fear losing money, but because they fear losing control. When your risk is small, your mind stays sharp. When it's big, your mind becomes a battlefield. Let's look at an example. Daniel, a beginner trader in Miami, had a $3,000 account. He took a massive trade, risking nearly $800 on one position because he believed he couldn't lose. The trade went against him. In one moment, he lost a quarter of his account. Panic set in. He doubled down, lost again. Within 48 hours, his account was nearly empty. Daniel didn't fail because he was unintelligent. He failed because he didn't respect risk. Months later, he returned to trading with a new philosophy. Protect capital first, grow it second. Today, he trades profitably. Not because his strategy changed, but because he changed. Risk management is not about being scared to lose. It's about ensuring that a single loss never destroys your future. It creates longevity, and longevity creates wealth. And here's the ultimate truth. Millionaires are not made from one big win. They are made from thousands of small, controlled, intelligent decisions. Your discipline in managing risk will be the strongest predictor of whether you reach 6 figures, then 7 figures, and beyond. In the next chapter, we'll step into the heart of the roadmap, building and refining your first trading strategy, because once your risk is under control, only then can your skills truly begin to scale. If risk management protects your capital, your trading strategy is what grows it. A strategy isn't a guess, a vibe, or something you follow because a YouTuber recommended it. A real strategy is a repeatable system, something you can execute with your eyes closed, something that removes emotion and replaces it with logic. This chapter is where your trading journey takes shape, because your first strategy becomes the backbone of everything that follows on your road to $1 million. Let's begin by clearing a huge misconception. A strategy is not about predicting the market, it's about responding to it. New traders often believe they need to know where the market is going, but professionals know that predictions are illusions. What matters is probability. You're not trying to be right every time. You're trying to make the right decisions based on the information in front of you. A strategy helps you do exactly that. A powerful trading strategy has 3 core parts: your entry, your exit, and your risk. Everything else, indicators, charts, time frames, exists to support those three pillars. Without them, you aren't trading, you're guessing. Let's break this down, starting with entry criteria. This is where you define exactly what must happen before you enter a trade. It could be a technical pattern, like a breakout above resistance, a moving average crossover, a pullback to a key demand zone, or a change in trend structure. The key is clarity. Your entry must be so clear that if someone else looked at your chart, they could instantly tell whether your conditions were met. No confusion, no improvisation. For example, a simple but powerful entry could be: the 20-period moving average crosses above the 50-period moving average, and the price retests the crossover level with a bullish candle. But remember, no bullet points. This is just an illustration of how specific an entry should be. Your strategy's entry should leave no room for doubt. When the conditions appear, you enter. When they don't, you stay out. Next comes exit criteria. Exits are often more important than entries. Anyone can enter a trade. Only disciplined traders know when to get out. Your exit criteria should include both a stop-loss level and a take-profit level. A stop-loss protects your capital, while a take-profit locks in gain. The goal is not to hold trades forever or to squeeze out every last dollar. The goal is to follow a system that produces consistent results. Some traders prefer fixed profits, like aiming for a 2-to-1 reward-to-risk ratio. Others use trailing stops to ride big trends. Both approaches can work. The key is consistency. You cannot switch between exit styles based on emotion. That's how small losses turn into big ones, and big wins turn into break-even trades. Now let's talk about time frames. Every strategy lives within a time frame. 1-minute charts, 15-minute charts, hourly charts, daily charts. Your personality determines your time frame. If you like fast action and don't want to hold trades overnight, you might choose intraday charts. If you prefer fewer decisions and lower stress, swing trading on 4-hour or daily charts might suit you. There is no best time frame, only the one you can execute consistently without emotional strain. Next is confirmation. You should always use 1 or 2 reliable tools to confirm your entry. Confirmation could be volume increasing, an RSI level showing momentum, or a candlestick pattern forming at a key price level. But don't overload your charts. Many beginners use 10 indicators, leaving themselves confused. The best strategies use minimal tools with maximum clarity. Once your structure is clear, it's time to test it. And this is where the real growth happens. Testing is done in 2 ways: back testing and forward testing. Back testing means applying your strategy to past chart data to see how it would have performed. You manually scroll through charts, marking entries and exits. You study hundreds of past movements to understand the strengths and weaknesses of your strategy. This gives you confidence and reveals patterns you wouldn't see in real time. Forward testing is using a demo account to trade your strategy in live markets. This stage introduces emotions, because even though the money isn't real, the pressure feels real. You watch your strategy perform in changing conditions. Trending markets, consolidations, volatile spikes, news events. Only once your strategy performs consistently in forward testing should you move it to real money. But here's something powerful. Your first strategy is not your final strategy. Every trader evolves. What you use today may improve, adapt, refine, or transform over time. Great traders rebuild their strategies like engineers, making small adjustments, testing new variations, responding to market shifts. You will do the same. Your job is not to be perfect. It is to be adaptable. Let's connect this with real life. During the 2021 US tech boom, breakout strategies performed beautifully. Traders bought every breakout on Tesla, Amazon, and Nvidia, and profits poured in. But when the market shifted into a choppy sideways phase, those same traders suffered losses. The ones who adapted, shifting from breakout setups to pullback setups, survived and thrived. The ones who didn't, they vanished. Strategy is not static. It lives and breathes with the market. Your strategy becomes your identity. It becomes the voice you trust during chaos, the guide that prevents you from acting emotionally, and the system that builds consistency. The purpose of a strategy is not to make you millions overnight. It is to make you the kind of trader who can make millions over time. Never forget this. Strategy beats emotion, system beats impulse, process beats hope. In the next chapter, we'll take this to the next level by diving into the most underrated yet most powerful factor in your trading success, your psychology. Because even with the perfect strategy, your mind can still sabotage you unless you learn how to control it like a true professional trader. You can have the best strategy in the world. You can understand charts, patterns, and indicators better than anyone. You can study for months, test your system, and prepare yourself with flawless logic. But the moment real money is on the line, something shocking happens. Your own mind becomes your greatest opponent. This chapter is about defeating that opponent, the emotional, impulsive, instinct-driven version of yourself, so you can trade with clarity, confidence, and control. Trading psychology is not just another concept. It is the heart of your success. The market doesn't beat most traders. Their emotions do: fear, greed, impatience, hesitation, revenge trading, FOMO, overconfidence. These forces quietly control your decisions, often without you noticing. And unless you learn to master them, the million-dollar roadmap becomes impossible to follow. Let's begin with fear. The most common enemy, fear, shows up in many forms. Fear of losing money, fear of missing out, fear of entering a trade, fear of holding a winning position, fear of pulling the trigger, even fear of closing a losing trade. Fear shrinks your world. It turns logical decisions into emotional reactions. A fearful trader sells too early, holds losing trades too long, and avoids opportunities because they're afraid of being wrong. To conquer fear, you must adopt a foundational belief. Losing is part of winning. Every trader takes losses. The greatest traders in the world lose daily. But what separates professionals from beginners is how they react. Professionals expect losses. They prepare for them. They size trades properly so a loss feels like a tiny inconvenience, not a catastrophic event. Fear fades when losses stop feeling dangerous, and that happens through discipline, not hope. Next, let's talk about greed, the silent destroyer. Greed whispers lies. It tells you to hold longer because it might go higher. It tells you to double your position, to win big this time. It tells you to break your rules because this trade feels different. Greed makes you forget your strategy and chase quick profits instead of long-term growth. But here's the truth. No millionaire trader ever built lasting wealth through greed. They built it through rules, through consistency, through self-control. Greed can only be defeated with structure, a predefined take-profit level, a fixed maximum risk, and a commitment to never move your stop-loss farther away. When your system protects you from your impulses, greed loses its grip. Then comes impatience. the silent killer of discipline. Impatience tells you that waiting is wasting time. It pushes you into trades that don't meet your criteria. It convinces you to do something, even when the market is giving you nothing. But great traders know the truth. Trading isn't about doing something. Trading is about waiting for the moment when doing something makes sense. The market rewards patience in ways that beginners cannot even imagine. A trader who waits for a perfect setup earns more from one good trade than an impatient trader earns from 10 sloppy ones. Once you understand that patience equals profit, waiting becomes your strongest weapon. Now let's address overconfidence. This emotion usually appears after a big win or a streak of success. You start believing you figured out the market. You increase your position sizes. You ignore your rules. You skip your analysis. And the market humbles you instantly. Overconfidence makes you blind to risk. It convinces you that the rules apply to everyone except you. That illusion has destroyed more accounts than any strategy mistake ever could. The cure: humility. Every morning, remind yourself, today I am a student of the market. Because the moment you believe you don't need discipline anymore, your downfall begins. Another major psychological trap is revenge trading, the urge to make back money immediately after a loss. Revenge trading is pure emotion, and emotion has no place in trading. You must learn to detach your self-worth from your trade results. A losing trade doesn't mean you're a bad trader. It means the market moved differently than expected. Nothing more. The fastest way to destroy your account is to take trades driven by anger or frustration. The strongest traders step away when emotions spike. They breathe, reset, and return with clarity, not vengeance. In the world of trading psychology, one of the most powerful concepts is acceptance. Acceptance means acknowledging that you cannot control the market, only your decisions. You cannot force a trend. You cannot stop volatility. You cannot protect yourself from unexpected news. But you can control your reaction. Acceptance transforms anxiety into peace. It helps you recognize that your job isn't to predict. Your job is to execute. The market is not an enemy. It's simply a system. And once you accept that, trading becomes less stressful and more strategic. Let's bring this to life with an example. Ava, a beginner trader from Texas, used to panic every time the price moved against her. Even small pullbacks caused her to close trades prematurely. She believed she was managing risk, but really fear was managing her. After months of journaling her emotions and reviewing her behavior, she learned something shocking. Her losses didn't come from her strategy. They came from fear-driven decisions. Once she started following her plan strictly, letting stop losses handle risk and letting targets guide profit, her account finally started to grow. She didn't change her strategy, she changed herself. That is the essence of trading psychology. Success is not about fighting the market. It's about fighting your impulses, master your emotions, and you master the game. And here's the most empowering truth of all. Psychology is the only part of trading you can fully control. You can't control price movement. You can't control news. You can't control volatility. But you can control your mindset, your discipline, your decisions. And that alone is enough to win. In the next chapter, we'll take your strategy and psychology and combine them into a powerful execution plan. You'll learn how to enter trades confidently, exit trades intelligently, and manage your positions like a professional. Because skill is built through practice, but mastery is built through execution. You now have a strategy. You understand your psychology. You know how to manage risk. But here's the truth many beginners overlook. Having a strategy isn't enough. Knowing what to do isn't enough. The difference between traders who become wealthy and those who remain stuck is not knowledge. It's execution. How you execute your trades determines everything. In this chapter, we'll transform your strategy from ideas on paper into real-world actions that generate consistent, controlled results. Execution begins long before you enter a trade. It starts with preparation, your daily ritual, your mindset check, your chart analysis. Think of trading like flying a plane. A pilot doesn't take off without reviewing instruments, weather, and flight paths. Likewise, a trader shouldn't click buy or sell without knowing exactly what they're doing. In the US markets, where billions move in minutes and volatility explodes on unexpected news, preparation becomes your shield. When the market opens, you should already have your levels marked, your signals identified, and your plan ready. Your first task is to understand this simple truth. Execution is about removing hesitation. When your strategy gives a signal, you take the trade. Not early, not late, not halfway. Hesitation is deadly. It causes you to enter too late, chase weak setups, or miss opportunities entirely. But confidence doesn't come from courage. It comes from preparation. When you trust your system, hesitation fades. Your hands move with certainty. Let's start with entries, the moment your trade begins. Entries must be clean, objective, and precise. You don't enter because you feel like it. You enter because your conditions are met. Exactly, not approximately. Picture yourself watching a stock approaching a key breakout level. Your plan says, if the price closes above this level with strong volume, I enter. A beginner might jump in early, hoping to get a better price. A professional waits. A beginner might panic if the candle moves too quickly. A professional stays focused. Entries are not guesses. They are decisions rooted in evidence. Execution also means using the right order types: market orders, limit orders, stop orders. Understanding when to use each is crucial. Market orders are fast but risky during volatility. Limit orders give you control but may miss the fill. Stop orders automate your entry when price reaches your level. Professional traders use order types strategically, not emotionally. They let the system do the work instead of clicking buttons in panic. Next, let's dive into trade management, one of the most overlooked aspects of trading. Managing a live trade is where your psychology is truly tested. When your trade is in profit, greed whispers, "Hold for more." When your trade is in a small drawdown, fear whispers, "Exit now before it gets worse." But execution demands something far more disciplined. You follow your plan. If your strategy says to hold until your target hits, you hold. If your stop loss hits, you exit. No negotiation, no improvisation. Your plan decides, you obey. One of the most powerful execution tools is the break-even rule. Once your trade is significantly in profit, you adjust your stop loss to break even, protecting yourself from losses if the market reverses. But you must apply this rule logically, not emotionally. Moving your stop loss too early can cause you to exit before the trade matures. Using it too late exposes you to unnecessary risk. This balance improves with time and experience, but the principle remains the same. Protect your capital while giving your trade space to breathe. Another advanced execution technique is scaling. Scaling in means entering a trade in parts. Scaling out means taking profits gradually instead of closing the full position at once. Many pro traders scale out. They take partial profits to secure gains while leaving part of the trade running. This reduces psychological pressure and helps you ride bigger trends without fear. Imagine catching a big S&P 500 breakout. You close half the position early to lock in profit and let the rest ride. Emotion drops, clarity rises. Let's talk about exits. The moment traders struggle with the most. A beginner exits too early because they fear losing what they've gained. Or they exit too late because greed clouds their judgment. Professionals exit based on structure, not emotion. If your target is hit, you exit. If your stop loss is hit, you exit. If a clear reversal signal appears and invalidates your setup, you exit. No guessing, no hoping. Exits are mechanical. They're decisions made long before the trade even begins. This brings us to a crucial rule of execution. Your job is not to control the outcome. Your job is to control the process. Too many traders watch their trades candle by candle, obsessing over micro movements. But this constant monitoring creates emotional stress. Instead, you should trust your stop loss and target. Walk away if you need to. Let your system do its job. Overmanaging a trade is just another form of fear. Let's bring this to life with an example. Lucas, a beginner trader from Chicago, used to enter trades perfectly, but exit them terribly. He would close winning trades early and hold losing trades too long. His strategy was good. His execution was not. After months of journaling, he realized that his trades lost money not because the market was against him, but because he kept interfering. He made a simple rule. Once a trade is placed, he steps away for 15 minutes. This small habit changed everything. His results improved instantly because his strategy finally had room to work. Another important part of execution is reviewing your performance. Every trade should be logged. Why you entered, why you exited, what happened in the market, and how you felt. Reviewing your trades weekly gives you patterns. You start noticing that your best trades come at certain times of day, or that you make mistakes when you're tired, or that certain setups work better on specific days of the week. Execution improves dramatically when you learn from your past behavior. And here's the final truth of this chapter. Great execution is what turns a strategy into wealth. A strategy without execution is like a map without a vehicle. Many traders know what to do, but only a few actually do it. The difference isn't intelligence, it's discipline. Professional execution is quiet, calm, systematic. It's not exciting, it's not dramatic, but it's consistent. And consistency is what compounds into $1 million. In the next chapter, we'll explore the stage every beginner dreams of reaching, the consistency phase. The moment when your skills stabilize, your emotions settle, and your trading account starts growing with rhythm. Because once your execution becomes disciplined, your results become predictable, and predictability is the first real doorway to wealth. If there is a moment in your trading journey that feels like magic, it's this one, the consistency phase. This is the moment when everything you've learned, risk management, psychology, strategy, execution, finally begins to click together like a lock meeting its key. The chaos quiets down, the confusion fades, the emotional roller coaster slows. For the first time, you watch your account grow in a steady rhythm instead of random spikes and painful drops. This phase is where traders evolve from beginners into professionals. It's the bridge between small results and big ambitions. And in this chapter, you'll understand how to enter this phase, how to stay in it, and how to let it shape you into the trader capable of achieving the $1 million milestone. Consistency is not about having more winning trades. It's about having more controlled trades. A consistent trader doesn't win every day. A consistent trader doesn't win every week. But a consistent trader wins over time. That is the definition of mastery, not perfection, but predictable progress. Predictability comes from discipline. Progress comes from repeatable habits. The trader who executes the same way, journals the same way, and follows rules the same way eventually gets the same result: steady upward growth. But reaching this phase requires crossing a psychological threshold. In the beginning, every trade feels personal. You judge yourself based on your last win or loss. You feel like your identity is tied to every outcome. But during the consistency phase, that emotional attachment disappears. You finally understand that each trade is just one of thousands. You stop giving each trade power over your mood. You stop seeing losses as threats and start seeing them as routine business expenses. The market no longer feels like a battlefield. It feels like a workspace, a place where you show up, execute, and leave. Let's talk about what consistency looks like in real life. Imagine waking up, reviewing your charts, identifying your setups, and executing without hesitation. You're not chasing the market. You're not overtrading. You're not reacting emotionally. You're simply following your system. You take 2 or 3 solid trades a day, maybe fewer. And when there's nothing to trade, you don't panic. You patiently sit out. You've finally learned that the market will always give opportunities. You don't need to force them. That calmness is the first sign that consistency is approaching. Now here's the surprising truth. The consistency phase often begins with trading less. Beginners think trading more equals making more. Professionals know the opposite is true. Consistency comes from selectivity. You stop taking low-quality setups. You stop trading during uncertain conditions. You trade only when your edge appears. This selectiveness increases your win rate because you eliminate the sloppy trades, the boredom trades, the emotional trades, the impatient trades. When your worst habits disappear, your best results finally have room to appear. Consistency also requires something subtle but incredibly powerful: environment control. The space where you trade influences your behavior. If you trade surrounded by noise, distraction, temptation, and pressure, your execution suffers. But if your environment is quiet, organized, and structured, your mind stays sharp. Many consistent traders create routines: a clean desk, a focused time slot, a specific window of market hours, a pre-market meditation, a review session at the end of the day. These routines create consistency even before you enter a single trade. Let's look at the story of Malik, a trader from San Francisco. For his first year, he was constantly inconsistent. Some weeks he made money, others he lost it all. His issue wasn't his strategy, it was his environment. He traded at random times on his phone, while distracted, while emotional. Once he switched to a structured routine, trading only during the first 2 hours of the US session, keeping a strict checklist, journaling daily. Everything changed. His results stabilized. He wasn't doing anything new. He was finally doing things consistently. Another pillar of the consistency phase is data-driven thinking. Emotion-driven traders focus on how they feel about their trades. Consistent traders focus on what their data says. When you journal every trade, entries, exits, emotions, mistakes, patterns emerge. You begin noticing which setups work best. You see which time frames produce your most profitable trades. You see which market conditions cause losses. Over weeks and months, your journal becomes a treasure map. It reveals your unique edge. Consistency isn't magic, it's analysis. It's improvement based on evidence. Here's something profound. Consistency is not just about performance, but identity. At some point in this journey, you stop calling yourself a beginner. You stop doubting your abilities. You stop fearing the market. You become a trader. Someone who operates with precision, confidence, and emotional maturity. This identity shift is powerful. It changes how you think, how you react, how you execute. You stop expecting perfection. You start expecting process. During this phase, your results become predictable. You begin to see the same setups appear again and again. You enter with confidence and exit with discipline. You no longer panic when a trade moves against you because your risk is controlled. You no longer celebrate excessively when a trade wins because you know it's just part of the system. This emotional balance is the hallmark of consistency, and something extraordinary begins to happen. Your equity curve starts rising steadily, not explosively, not dramatically, but steadily. Maybe you grow 5% per month, maybe 10%, maybe more, but the growth is controlled, reliable, repeatable. It's the kind of growth that compounds over time. It's the kind of growth that builds 6 figures, then 7. But consistency doesn't mean boredom. It means mastery. The same way a professional athlete performs the same drills every day, or a musician plays the same scales, or a surgeon repeats the same motions. A professional trader repeats the same process. Repetition is the mother of skill. Skill is the father of consistency, and consistency is the gateway to wealth. And here's the final truth of this chapter. The consistency phase is not the end of your journey. It's the beginning of the real journey. Because once you become consistent with small capital, you're ready to enter the next stage, scaling. The phase where your skill meets opportunity and your account begins to grow exponentially. In the next chapter, we will explore this thrilling next step: how to scale your trading like a professional, increase your position sizes responsibly, and transform consistent results into the foundation of a $1 million account. You've made it through the phases that break most beginners. You've built a strategy. You've mastered your psychology. You've learned to execute with precision. You've entered the consistency phase where your account grows slowly, steadily, predictably. Now comes the final and most thrilling stage of the roadmap: scaling. This is where your results multiply. This is where your discipline turns into dollars. This is where your journey transforms from trader to wealth builder. But let's be clear, scaling is not about taking bigger risks. It's not about doubling your trades or chasing faster profits. Scaling is about doing the same things that made you consistent, just with more capital. It's a controlled evolution, a gradual expansion, a methodical climb. The same way a weightlifter starts small and slowly adds more weight as strength increases, a trader scales position sizes only when discipline, data, and confidence are strong enough to support it. To understand scaling, imagine your trading account as a machine. In the beginning, the machine is small. It produces small profits because your risk is small. As you become consistent, the machine becomes more efficient. It produces profit regularly. Scaling is simply turning up the machine's output, not by changing its design, but by increasing the power flowing into it. Let's start with safe scaling, the approach used by professional traders and fund managers. Safe scaling means increasing your position size gradually based on performance metrics. For example, once you are profitable for 3 consecutive months with your current risk level, you increase your per-trade risk from 1% to 1.25%. After another period of success, you move from 1.25% to 1.5%. This slow, incremental scaling ensures your psychology remains stable. If you jump from risking $20 per trade to $200 overnight, your fear skyrockets and your execution collapses. But if you increase in small steps, your mind adapts effortlessly. Now let's talk about compound growth, the force that builds millionaires silently. Compounding means reinvesting your profits instead of withdrawing them too soon. A 5% monthly return may sound small, but compounding transforms it into exponential growth over time. For example, a $5,000 account growing at 5% per month becomes nearly $9,000 after 1 year, $14,000 after 2 years, $23,000 after 3, and continues accelerating. Scaling combined with compounding creates a curve that bends upward, slowly at first, then powerfully. But scaling is not purely mathematical, it's deeply psychological. When your position sizes grow, your emotional reactions grow too. A $50 loss feels different from a $500 loss, even if it's the same percentage. Humans are wired to react emotionally to large numbers. This is why scaling too quickly destroys traders. They believe they're ready because their strategy works at small size. But when the dollar amounts grow, fear returns, hesitation returns, greed returns. Suddenly the same setups feel risky, the same trades feel heavier. Scaling is as much about emotional conditioning as it is about strategy. This brings us to performance thresholds, milestones you use to determine when you are mentally and technically ready to scale. Thresholds could include achieving a specific win rate, maintaining controlled drawdowns, avoiding revenge trading, or proving consistent profitability over a period of weeks or months. These thresholds help you scale without guessing. You don't increase size because you feel ready. You increase because your data proves you are ready. Another key concept in scaling is diversification within your trading system. When your account grows, you can expand into additional markets or strategies. For example, a trader who begins with US tech stocks might later add Forex or commodities once consistency is achieved. This doesn't mean trading everything at once. It means building multiple edges over time. Diversification stabilizes performance and reduces risk when one market becomes slow or unpredictable. One of the most powerful elements of scaling is developing controlled ambition. Ambition drives you to grow, but discipline controls how you grow. You must avoid the temptation to scale aggressively during winning streaks or to shrink too much during losing streaks. Scaling requires emotional neutrality, the same quality you develop during the consistency phase. Let's bring this to life with a real example. Jacob, a trader from Florida, started with just $2,500. For 6 months, he followed a strict strategy, risking 1% per trade. His results were steady, not explosive, but reliable. After 6 profitable months, he increased his risk to 1.25%, then 1.5%. By the end of the first year, he was trading confidently with 2% risk per trade, earning larger profits without increasing stress. By year 2, he had diversified into 2 strategies and was managing nearly $30,000. And by year 3, through disciplined scaling and compound growth, he surpassed $100,000. Jacob didn't get lucky. He didn't find a magical indicator. He followed the roadmap. He scaled slowly, and he let discipline multiply his capital. The final element of scaling is lifestyle alignment. As your account grows, trading becomes more than a skill. It becomes a vehicle for your ideal life. You set withdrawal plans. You build long-term investment accounts. You allocate a portion of your profits towards savings, real estate, or business ventures. Trading becomes the engine, not the destination. Millionaires don't rely solely on trading income. They use their trading profits to build multiple streams of wealth. That's how they stay wealthy long after the markets change. And this brings us to the final truth of your journey. Becoming a millionaire from trading isn't about one big win. It's about thousands of disciplined decisions compounded over time. It's not about speed, it's about precision. It's not about luck, it's about mastery. It's not about predicting the market. It's about reading it, adapting to it, and respecting it. And now, standing here at the final chapter of this roadmap, you are no longer the beginner who started this book. You understand the market. You understand yourself. You have the tools, the strategy, the psychology, and the discipline. You have the roadmap. The same roadmap walked by every trader who's ever reached 7 figures. Your journey from 0 to $1 million is not a question of possibility. It is only a question of time and consistency. And before you go, if you want to deepen your understanding of the markets and take your trading foundation even further, the perfect follow-up audiobook is Basics of Stock Market. It will give you the complete understanding of how markets operate behind the scenes, the structure, the mechanics, the behavior, and the opportunities. Because while trading builds skill, market knowledge builds power. Your next step is clear. Your roadmap is ready. Your future is waiting. Now you know the complete roadmap to trading. But what if I tell you, having the knowledge of only trading will not guarantee success? Trading involves understanding the basics of the stock market to support your trading decisions. To get a complete understanding of the stock market and leverage this knowledge for your trading journey, click on the video popping up on the screen.